is whatever's happening today. There's nothing extraordinary about it. Markets have been volatile. They were volatile 2 years ago. They were volatile 10 years ago. They were volatile 100 years ago, right? So this is the nature of markets. The nature of stock markets and financial markets generally is that there will be events every other year. You'll run into events which you have never seen before. And the nature of investing, the skill of an investor lies in identifying companies that will be able to make money regardless of the external circumstances, right? So that's the general sort of truth. And we've spent a lot of time in Marcellus, as you very kindly referenced. We've described in our books what sort of companies are able to make money regardless of what the external circumstances are. Specifically with regards to the current situation, it is relatively clear that the world is fragmenting into two competing blocks: an authoritarian bloc with China and Russia at the leadership, at the helm of that, with satellite states like say Pakistan, North Korea, Cambodia, Burma aligned to the authoritarian bloc, and a democratic bloc with North America, Europe, Japan and India at the vanguard of that. So there's two blocks. India more likely than not will align with the democratic bloc, and the quid pro quo, from what we can see, that's the quid pro quo that's ending up happening is the democratic bloc is asking India to join the bloc, and India I think is implicitly saying if you invest in India, if you the Western world, if you the Japanese invest in India both through the stock market and through foreign direct investment, if you send your IT services work, your payroll, finance, accounting, audit, HR work to India, to the KPOs in Bangalore, Hyderabad, Kerala, Gurgaon, etc., then we, the Indians, we will align our fortunes with you, because the scope of this mutually beneficial exchange is so powerful, right? And we've already seen in the last couple of years the power of foreign capital. FPI plus FDI, foreign portfolio plus foreign portfolio plus foreign direct investment is pushing towards $100 billion a year. Plus India's services exports are burgeoning. I think India's services exports now are $250 billion a year. I think the next 10 years bode well for India from a GDP growth perspective. I think the economic growth outlook is probably brighter than it's ever been for the country. But alongside that, it's relatively clear we will get elevated levels of inflation. Two different drivers of elevated levels of inflation. One is labor scarcity in our country. Formal job creation in India is running at spectacular levels. So the EPFO published data, which the CMI validated, saying that in the last 3 years, we've created 33 million formal sector jobs in India. That's a spectacular number. I haven't seen job creation on this scale in the formal sector in India before. It's clear that in various sectors, financial services, IT services, transport, there's already a labor and talent shortage. Wage inflation is running at 15-20% comfortably, and that will, I think, become a dynamic. So a shortage of skilled labor will become a dynamic that will push inflation up in India. Secondly, as China, and I think as was mentioned in the question, as China unhinges, delinks from the Western world, a lot of Chinese goods, a lot of low-cost Chinese goods, toys, electronics, specialty chemicals, a lot of low-cost Chinese goods that were taken for granted will suddenly disappear. And China will stop exporting deflation, and China effectively will start exporting inflation. So as you break up global trade as it has stood in the last 20-30 years, imported items will start costing more. That, combined with wage inflation in India, will result, I think, in elevated levels of CPI inflation in India. So this combination of a strong GDP growth alongside strong inflation is a fertile ground for investing in high quality companies. In India, we've seen historically that the sorts of high quality companies that Marcellus invests in, companies like Pidilite, like Asian Paints, like HDFC Bank, have excelled when input cost inflation has been high. The worst thing investors can do over the next 3-4 years is invest in fixed deposits, government bonds, corporate bonds, right? That's where anything which is a fixed income instrument will destroy investors' wealth, as inflation will ravage the value of bond and bond-like assets. So the beautiful thing about stock markets is the same movie plays time and time again, decade after decade. It's the same movie that's played out, right? A lot of people would have got used to watching, Avengers Part 1, Avengers Part 2, Avengers Part 3, Avengers Part 4. The stock market, the franchise works on a decadal cycle. So in the late 90s, I was in college then, but I've read about it. In the late 90s, between 95 to 2000, every day there were 1 or 2 IPOs. Most of these were IT services companies. The promoters took the money, ran away. They haven't been seen for the last 20 years. If you look at the thousands of IT services companies that went public in the late 90s, barely a dozen or so are around today and are creating wealth for shareholders. 99% of the promoters took the money and ran. Some were corrupt, some were incompetent, some were a mixture of the two. Similarly, as you were alluding to, sir, that power and infrastructure boom from 2005 to 12, I struggle to think of any company barring, say, perhaps a Tata Power that has stayed around to create some modicum of shareholder wealth. The vast majority of those promoters also took the money and ran. And no different today. The vast majority of the fintech companies, either the books don't stack up, the ones that have gone public, the books don't stack up, or the promoters are incompetent. There are, I think, of this kind of vintage of IPOs that we have seen in the last 12 months. I've only seen a couple of companies which actually pass sensible muster. The rest of them are of the same old sort of low quality promoters, and it will be no different 10 years hence. Today's craze was fintech or consumer tech. 10 years from now, perhaps colonizing Mars will be the next craze, and as night follows day, there'll be a bunch of very clever Indian companies that will sell dreams to people in Kerala, saying invest with us and colonize Mars, and those promoters will raise money and run away. So there's no difference. The same movie plays out again and again, and all you and I have to do is be vigilant. We have to realize that 90% of IPOs are a waste of time. 1 in 10 IPOs will be well-run, healthy companies that will actually give you a decent return. Yeah, so I think, look, you're in our job is not law enforcement. There's a very able and muscular regulator to do the law enforcement. I think from the limited perspective of those who are listening, just as you and I don't go to watch whatever movie comes to the cinema hall, right? At least I've never believed that first day first show is some great privilege. Just as you and I don't go to rush off to watch whatever is the latest movie, and you and I know that Sholay in 1976 is an all-time classics, and Dilwale Dulhaniya Le Jayenge in 1995 is an all-time classic, and not every week we will get a Sholay or a Dilwale DDLJ. Similarly in IPOs, just because it's that week's fresh issue doesn't mean there's some burning reason for you to invest in it. Let the company stay, let the company build a track record at your leisure. Once you've seen whether the promoter is clean, intelligent, can build a strong business at your leisure, then you go and invest. Don't get carried away by the frenzy and the craze and the artificial mania that is built around IPOs. I don't think there's any great secret. I think, as you said, we've written several books about it. I love the fact that you mentioned that we are voluminous writers. We write so that millions of people who will never be able to meet us and who we will never be able to meet, so that they can also benefit from whatever research we do. And the formula for identifying companies which generate free cash flow and compound shareholders wealth, the formula is relatively simple. In Coffee Can Investing, I think that's probably the simplest of our books to understand. In Coffee Can Investing, we boiled it down to 2 simple numbers that you need to look at. So look at companies whose pre-tax ROC is at least 15% consistently over a 10-year basis, and alongside 15% or better pre-tax ROC on a 10-year basis. Alongside that, also make sure that the company has double-digit revenue growth every year on a 10-year basis. Right? That's the simplest we can make it. And interestingly, you can go back to Coffee Can. Whoever wants to go back to Coffee Can Investing, look at the names that we have suggested. They've done well over the last 5-6 years. Before Coffee Can Investing, we wrote a book called Unusual Billionaires in 2016, where we gave detailed case studies of some of these companies and explained why companies whose return on capital is at least 15%, who grow at double digits, can create wealth for you. So what we do is quite simple, as explained in our books. I think Diamonds in the Dust is probably the most sophisticated of our books. In Diamonds in the Dust, we've taken the reader as close to our skill set as we can. But if you don't want a difficult book, you want a very straightforward book, then read Coffee Can Investing. It will give you a simple mantra for compounding your wealth. The hard part in this is not reading the book. I think buying the book for a couple of ₹100, and unfortunately pirated copies in India sell for even less, right? Buying the book is easy. The hard part is following the principles on a consistent basis. So what we do is simple, but it's not easy to do. Just as what Warren Buffett does, and Warren Buffett's been writing and talking about it for 50 years. What Berkshire Hathaway does is simple, but it's not easy to do, which is why there's only one Warren Buffett. That's why what we do is also quite simple. In fact, it's much simpler than what Mr. Buffett does in the American context. But for the reasons we've been discussing, people get carried away by stock market frenzies, they get carried away by the war in Ukraine, whatever election is happening, and those sorts of distractions unfortunately get in the way of investors getting a fair return on their hard-earned savings. I think there's one intervention which is already in place. It's called NPS, National Pension Scheme. I'm an NPS investor myself. All Marcellus employees are encouraged to sign up for NPS. Several of my colleagues in Marcellus are NPS. I think NPS in a way is the ideal construct for retail investors. The expense ratio, the charges are low. It's as little as 10 bips, I think, 0.1%. The money basically is entrusted. The trustee is actually the NPS itself. The effectively a government of India body is a trustee. So your savings are safe. The fund manager you can choose. I think HDFC pension fund, ICICI has a pension fund. So the trustees are private sector fund managers. The rules are such that you put away a sum of money every month. Your employer contributes a similar amount. Up to 2.5 lakhs per month, I think, is tax free. You're not allowed to encash that till the age of 70. And there's a formula via which I think when you're young, a heavy amount of that goes into equities. As you approach 70, the equity portion reduces, you put more in bonds. I think the NPS is a tremendous way for retail investors to save. And those who are watching, if you can avail of it, make sure you do. I avail of my entire 2.5 lakhs of tax exempt quota every year. And I'm a very happy investor in NPS. I wish more people did the NPS. It's almost the perfect way for small ticket investors to compound their hard-earned money. My tips for investors. I think read as much as you can. Read good books on investing. Stay aware. Just as for us to stay safe, we have security guards outside our building. The venue at which you and I are speaking, I saw 3 security guards at the entrance. If you don't want to look after your own money yourself, hire a high quality security guard to look after your money. Because if you don't protect your money and you don't look after your money, nobody will. The good thing about the current day and age is courtesy the internet, courtesy personal finance publications, the information is available. But if you and I don't make the time and effort to protect our money, invest our money wisely, it's not going to automatically happen. There is no God-given rule which says that just because India's economy is growing at a rapid rate doesn't mean your wealth will grow at a rapid rate. The simplest way I have found of investing my money, the method that we have described in Coffee Can Investing, is 70-80% of my family's savings I put in these sorts of stocks, the consistent compounder type stocks, clean, well-run, dominant franchises. 20-30% is our safe harbor, is our rainy day fund. The safe harbor money is in fixed deposits and GSECs. That's the fallback if something happens to us. But other than that, the rest of our money is compounding away and is invested in high quality Indian companies who are able to grow their business at around 20% a year. Simple way to do it. I've described more in Coffee Can Investing. Whether you read Coffee Can Investing, you read other books, but make an effort, because if you don't make an effort, what will happen to you is what's happened to the vast majority of Indians. A lifetime spent working hard but the wealth compounds at a rate of return below inflation. So the stocks I'll recommend, they're part of Marcellus's consistent compounders portfolio. I myself and my parents and my colleagues, we're all investors in the consistent compounders portfolio. So the 5 stocks I am going to recommend, I also have a vested interest in recommending them to you. So with that double disclaimer, I would suggest you should consider investing in Asian Paints, in HDFC Bank, in Bajaj Finance, in Pidilite, and in Titan. Straightforward companies that we've invested in for a long period of time, and companies I would suggest you should think about. Please do your own work, do your own research, and if you don't want to do the research, then at least read our books, because we've given our points of view there.